Hey guys, what's up? I'm Erin and welcome back to the channel. What if I told you there was a new tax bill that could boost your refund, increase the tax credit, and just reduce how much you owe in taxes in 2026? You'd wonder, is there a catch, right? Well, a sweeping new tax proposal was just introduced to the House, and it could really shake up your finances in a big way. From standard deductions to business taxes to estate planning, this bill is packed, and yes, it's already getting a lot of buzz. So let's break it down. No politics, that's not what this channel is about, just the facts. Who this bill might help, who it might hurt, and what you need to know before the headlines take over. This new tax bill was introduced by the House Ways and Means Committee on May 9th, 2025. And while it doesn't have an official title just yet, it's casually being referred to by some, including President Trump, as one big, beautiful bill. The goal? To extend and expand the 2017 Tax Cuts and Jobs Act, many of which are set to expire after 2025. The bill aims to boost take-home pay, shrink tax bills, and really keep the Tax Cut and Jobs Act alive for the long haul. But there is more going on beneath the surface. Let's dive into what this bill is actually proposing. Because whether you are a parent, a business owner, or just someone who files a basic return, these changes could affect you. Let's start with the standard deduction, because this one affects nearly every taxpayer. As of 2025, the standard deduction is set at $15,000 for single filers, $22,500 for heads of household, and $30,000 for married couples filing jointly. These amounts come from the 2017 Trump tax cuts, but there's a catch. They are set to expire after 2025. So without new legislation, the standard deduction could drop sharply in 2026. For singles, it could go down to $8,000 to $9,000. For heads of household, maybe in the $12,000 to $13,000 range. And for married couples filing jointly, maybe to the $16,000 to $18,000 range. These are best estimates based on inflation adjustments. This would make more of your income taxable. This would affect millions of households and hit them with a higher tax bill. The new GOP bill addresses this in two ways. It makes the Tax Cut and Job Act standard deduction permanent. It doesn't vanish in 2026. And it also gives a little bonus. From the years 2025 through 2028, there would be an increase in the standard deduction. For singles and heads of household, they would get an increase by $1,500. For those married and filing jointly, they would get an increase by $3,000. So if this were to pass, here's what the standard deduction would look like from 2025 to 2028. $16,500 for single filers, $2,400 for those heads of household, and $33,000 for married couples filing jointly. It's a short-term boost paired with a long-term protection from a major tax hike. In plain terms, it prevents you from losing ground after 2025, and in the meantime, gives you more breathing room in your budget. Next up is the child tax credit, which is currently set at $2,000 per child. And here's something a lot of people don't realize. That number is not indexed for inflation. It was set at $2,000 in 2017 and hasn't changed since. Under the new GOP proposal, the child care credit would increase temporarily to $2,500 from 2025 through 2028. And that extra $500 for families who have multiple children can really add up. Then in 2029, the child credit would revert to $2,000, but with a major change. Now it would be indexed to inflation, which means it would maintain its value over time, increasing each year with the cost of living. It is worth noting, to qualify, your child still needs a valid Social Security number, so the eligibility rules aren't changing, just the dollar amount and future indexing. So in short, this change offers a short-term boost for families through 2028 and long-term protection from inflation eroding the value of the credit over time. This next one doesn't get a lot of headlines, but it could make a big difference over time. especially if you're someone whose income slowly increases from year to year. Right now, federal income tax brackets are adjusted annually for inflation, but they're adjusted based on a very specific formula and tied to something called chained CPI. So what is that? Here's the simple breakdown. The CPI, or the Consumer Price Index, tracks the rising cost of a fixed basket of goods: groceries, gas, rent, and so on. Chained CPI does something extra. It assumes that when prices go up, you adjust your behavior, like switching from steak to chicken, or going from more name brands to generic, so your cost of living doesn't rise as much. As a result, chained CPI grows much more slowly than regular CPI, and so that means that our tax brackets don't increase as much over time. So slowly but surely, more of your income ends up being taxed at a higher rate, even if your paycheck is simply keeping pace with inflation. That's what's known as bracket creep. The new GOP bill proposes switching back to using regular CPI for federal tax brackets. This would allow these tax brackets to better keep pace with inflation and prevent more of this stealthy tax creep. But here's something worth knowing. That switch to using chained CPI happened in 2017, and it was intentional. Why? Because it was a way for the government to collect more in tax revenue over time without adjusting tax rates. As wages increase, more income gets taxed at higher levels, even though your buying power hasn't improved. It was a built-in budget offset to help pay for the 2017 tax cuts. Subtle, slow, and easy to miss, but over time, it adds up, especially for middle-income earners. So this change back to using traditional CPI isn't just a technical one. It's about putting more of your hard-earned money back in your pocket and keeping these federal tax brackets more aligned with true inflation and the true cost of living. Right now, the federal estate and gift tax exemption is about $13.9 million per person. This is already a historically high number, but under the new GOP tax proposal, it would increase to $15 million and it would be made permanent. And this would protect it from reverting back to pre-2017 numbers after the year 2025. This is a really big deal for high net worth individuals and those doing legacy planning. It allows them to pass on more wealth to their heirs or perhaps even gift more during their lifetime without having to trigger federal estate or gift taxes. Like so many other parts of this bill, this $15 million limit would be indexed for inflation, so it would increase over time and help to preserve its value over time. The bill would also align the same generation skipping transfer tax, GST tax exemption, with the same $15 million level. Since the GST tax adds an extra 40% tax when skipping a generation, this change helps avoid surprise penalties for those passing assets to grandchildren or beyond. The bill also takes aim at business taxes, specifically by expanding the Tax Cuts and Jobs Act's business-friendly provisions. That means the 20% deduction for qualified pass-through businesses like LLCs, partnerships, and S-corps would continue permanently. The same goes for reduced corporate tax rates, which as of 2017 was slashed from 35% to 21%. And this can really help small and mid-sized businesses keep more of their earnings, which they can then invest in operations or increase wages. This is especially relevant for fields like healthcare, law, real estate, and other professional services that often operate under pass-through structures. Let's take a moment and talk about the SALT deduction, which stands for state and local taxes. This includes state income taxes, property taxes, and some local taxes. Before 2018, if you itemized your taxes, you could deduct all of your SALT payment from your federal taxes, no cap. But the 2017 tax law changed that. It put a limit of $10,000 on this deduction, no matter how much you paid. Here's why this matters. In many high-tax states like California, New York, or Illinois, many high-income earners and many homeowners pay well over $10,000 in state and property taxes. But regardless of how much they pay, they can only deduct up to $10,000. The rest doesn't matter. The new GOP bill proposes raising that limit to $30,000, allowing those who are living in these high tax areas to deduct more of what they're actually paying. For example, if you paid $24,000 in state and local taxes last year, right now you'd only get to deduct $10,000. But under the new proposal, you'd be able to deduct the full $24,000. But here's the catch. This change would mainly benefit people who own homes, live in high tax states, and itemize deductions. If you take the standard deduction, the SALT cap wouldn't even affect your tax return whatsoever. But this part of the bill is pretty controversial because some say that this is giving those who live in high tax areas much needed tax relief. Others say that it's primarily affecting just high income earning households. So what's the real impact? Let's look at both sides. On the pros, it could put more money back in your pocket starting in 2026. The higher child tax credit would help families with dependents. Bracket inflation adjustments would help to fight stealth tax hikes. The permanently higher estate exemptions could simplify planning, and businesses benefit from extended deductions and lower rates. On the flip side, the cons, this bill is expected to reduce federal revenues by $4.9 trillion over the next 10 years. To help offset the bill's $4.9 trillion miss, lawmakers have floated potential cuts to programs like Medicaid and clean energy incentives. Now keep in mind these cuts are not detailed within this plan itself. They have just been mentioned when talking about budget-related cuts. So it's important to keep in mind that there would very likely be trade-offs, and these trade-offs could affect social and environmental programs, just to keep things budget neutral. Some low-income families may see limited benefits if they don't meet CTC requirements. This does raise deficit concerns, especially with other large spending on the horizon, and SALT cap changes may not fully satisfy high-tax states. So is this one big, beautiful tax break, or is it just a short-term boost with long-term trade-offs? That depends on your income, your family situation, and how much weight you give to things like the deficit or social program funding. One thing is clear, this bill is opening up the door to a very large tax debate that is expected to be coming as we look at the Tax Cuts and Jobs Act expiring in 2026. So let me know your thoughts. Would this bill affect you, or would it not make much of a difference at all? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Oh no! Both of my lights burned up? Oh, that's so frustrating. Okay, those are battery-powered lights. Well, the lights were on in the beginning of the video. Proposal, it would actually increase temporarily from... Why is the dog barking so much today? Again, I want to reiterate, this is not my dog. My dog is well behaved. Increase at a pace that's more aligned with true inflation. Right now, the federal estate and gift tax exemption is about 13. It says 13.6, but I believe it's 13.9. Do you think I just say it, or do you think I have to fact check it? It's 13.9, right? This is already a historically high number, but the new proposal in the GOP